Hey everybody, Courtney Smith here with our March 15th edition of Wall Street Winners. All right, let's get right. And this is the March 15th edition of our disclaimer. Okay, so the S&P rallied right back up again. Purple Predictor remains concerning, but notice how it's rebounded sharply. But that's following the collapse that we had before since the middle of February. But let's kind of discount it a little bit right now. The fact is, we broke to new all-time highs on Thursday. Remember, price action is the most important thing. Now, let me point something else out to you that makes me nervous. Look down at the bottom of the chart and look at the volume. As we rallied, volume went down. Volume is a confirming factor. When you look at volume, if it's going down and we have a bull market, it's not confirming the bull market. So don't look for much more on the upside. I think we're going to be going into a kind of a choppy, sloppy mode for the next several months. We'll take a look at the seasonality. Dow Jones, some buying pressure came back into the market. Still like being in Dow type stocks rather than NASDAQ type stocks. And here we see the NASDAQ much weaker than either the S&P. We're a long way away from new all-time highs. Let's go back over there. We made new all-time highs on Wednesday, Thursday, and Friday of last week in the Dow. Not even close on the NASDAQ. Now, seasonality. We're bullish. There's no question about that. You can see we've broken to new highs. We won't turn bearish until I'm going to move the bearish up probably next week to about 207. Now, on the utilities, if we break above 64 even, I'll turn back to the bullish side. We're coming up to the bullish period May 1st, so we're not there yet, so I don't expect anything to be a breakout. But once we get into April, I'll definitely go bullish if we break above 64. So we're getting there. Now, if we look down at the bottom, the purple and red lines, choppy, sloppy sideways right now. Okay, so look for this week to be a whole lot of nothing. You can see even the green lines, the blue line, the black line, they're not going anywhere either. And it's going to be that way probably for another month. You can see almost, we kind of get a little bit of a rally, then a dip through April, and then we get a nice rally at the end of April up into May. So that's pretty good, but then a big dip from May to July. So this summer, starting really a little bit of an upward bias, but generally speaking, we're going to be running into September, not making much headway to the upside. And I'll explain why. Let me stop for a second. Has Fed policy gone too far? The Biden administration is putting in lots of anti-growth policies. They're going to slow economic growth. So if they slow economic growth, but the Fed is pumping money into the system, does that mean stagflation is back? It may be, and that's not good for the market. Not good for the market at all. Okay, asset allocation, they are bailing out of bonds. This relates to what I just said. The market is really looking for a rebound in inflation, so they're causing long-term interest rates to go up. So they're selling bonds and they're buying stocks. They're moving from less risky assets to more risky assets, thus creating the next bear market. Thank you very much, Jerome Powell. Our stock market risk indicator also approaching all-time highs. Once again, you want a certain amount of risk in the market. You don't want too much risk in the market. Starting to get worried. Okay, global shares not anywhere near all-time highs. So once again, prefer to be in the U.S. Yield curve skyrockets up to the 160 level. I've been talking about 150 for a long time. This is actually bullish for the stock market. The question is are the long-term interest rates too high? Are they going to start choking off mortgages and things like that? The answer is yes. Bonds collapsed to new lows on Friday. Thank you so very much. We'll just take that one to the bank and look for them to go lower, even lower. Bond key factors all remain looking for higher interest rates except the price of gold. And the price of gold, paradoxically, is going down because interest rates are too high. So as interest rates get too high, real interest rates get really high, and that crushes the gold market because real interest rates, inflation, and Indian wedding season are the three dominant factors that drive the gold market. Dollar I'm bullish on the dollar, but not enough to get really excited about it. We got a little bit of a setback and then showed some rally on Friday. I'm not doing anything here. But gold, I wish I was short, but I'm not, because that's a pretty sloppy bear market. Given that the real interest rates are going up, given that there's no Indian wedding season, and given that inflation hasn't yet started to come up, suggests that gold will remain under pressure. Do not listen to the Johnny One Notes. Gold key indicators are bearish. Two are bearish, one is neutral, and the one that was neutral used to be bullish. Look at the middle panel. It was going up since November of last year, but now it's stalled out. So one of the bullish underpinnings of the stock market has disappeared. Crude oil, chop, chop, chop. Like I say, listen, demand is going up, supply is going up, but demand is going up more. So we should continue to see a sloppy, and it's going to get sloppier. In other words, more down moves, more up moves, more sideways moves. It's not going to be as easy to trade. Not that I made any money on the long side in crude oil, although I did make money in gasoline. And Bitcoin broke to a new high as well. So we've been bullish, but not wildly bullish. Now we have to be turning back much more bullish now that we've broken to the upside. So we never recommended that you got out of your long positions ever since, gosh, I don't know, since at, 16,000, something like that. I forget. Anyway, here we are at 61,000, almost 62. All right, freebies, thanks for dropping by and partaking in the Wall Street winners' wisdom. Fully paid up members, hang on for just a second. Hey, freebies for Wall Street winners. Really appreciate having you here and love to have you participate in the Wall Street winners every week. But I also wanted to show you where I get a lot of my information and where I monitor my information, and it's from the Stock Butler, stockbutler.com. And what it is that it takes the system that I teach in my Stock Financial Freedom System course, my live 2-day seminar, and it codifies and systematizes and makes it super easy to use. Let me just show you some of the things. I would go there, read their literature. That's really great. But let me show you a couple of things that I use. So I always talk about in Wall Street Winners our best of the best stocks. Now, when you're a fully paid up member, you see my best of the best stocks. But for example, I can come up here and I hit rate and I go to best of the best and I click on it. Now I've already signed in. There it is. There's my best of the best stock. These are the best of the best stocks that you should be looking at buying. In this particular case, you can see the green one is a new one this week. So guess what? In the fully paid up section, this is a new recommendation. We also, Stock Butler also rates the stocks, A, B, C. Here is a change. This one was changed in its rating. So it does some amazing things. It makes it super easy for you to trade, to monitor. It also has other techniques up here. Our hot hands, our pit bulls, seasonality, advanced stock list, many different ways in order to find great stocks and then to monitor them. So when you click on one of these stocks, it comes back and it tells you how the rating occurred. Here's the actual analysis that went in to rating this stock a B. Incredible. And the cost is nominal. I highly recommend it. Go there to stockbutler.com and check it out. I think you're going to love it. Talk to you later.